Have you ever wondered how people actually buy houses that cost hundreds of thousands of dollars when they don't have that kind of money sitting in their bank account? Here's a hint, they don't. They use something called a mortgage, a fancy word that basically means a really big loan to buy a house. But how does it work? Who gives you that money? And what happens if you can't pay it back? Stick around, because by the end of this video, you'll understand mortgages like you're five, simple, clear, and easy enough for anyone to get it. Welcome back to the channel. If you're new here, we make money and finance easy, so you can actually understand the stuff that schools never teach you. If that sounds useful, hit that like button, subscribe, and let's make money simple again. Section 1. What is a mortgage? Alright, let's start with the basics. Imagine you want to buy a house that costs $300,000, but you only have $20,000 saved up. You don't have the rest, and that's where a mortgage comes in. A mortgage is when a bank or lender gives you the rest of the money to buy that house. In return, you promise to pay them back slowly, usually over 15 to 30 years, plus interest. So basically, you get the house. The bank gets payments every month. If you stop paying, the bank can take the house back. That's why a mortgage is also called a secured loan, because it's secured by your house. Section 2. How mortgages work. Let's break down the main parts of a mortgage. Principal, this is the actual money you borrowed. Interest, this is what the bank charges you for lending you that money. Term, the number of years you have to pay it off, like 15, 20, or 30 years. Monthly payment, what you pay every month, which includes both principal and interest. So if you borrowed $280,000 for 30 years at a 6% interest rate, your monthly payment might be around $1,600, $1,700. Sounds simple, right? But there's more to it. Section 3. Fixed versus adjustable rates. There are two main types of mortgage interest rates. Fixed rate mortgage, your interest rate stays the same for the entire loan. That means your monthly payment doesn't change. Stable and predictable. Adjustable rate mortgage arm. Your interest rate can change after a few years, depending on the market. That means your monthly payment can go up or down. Most people prefer fixed-rate mortgages because they are simpler and safer, especially if you're replanning to stay in your home for a long time. Section 4. Down payments and why they matter. Remember the $20,000 you had saved? That's called your down payment. The bigger your down payment, the less you have to borrow, and the less you'll pay in interest over time. Most lenders ask for at least 3% to 20% down. But if you put down less than 20%, you might have to pay PMI private mortgage insurance. That's basically a fee to protect the bank in case you stop paying. So, the takeaway, save for a bigger down payment if you can. It'll save you thousands in the long run. Section 5. What's inside a monthly payment? When you make your monthly mortgage payment, it's not just for the loan. It usually includes 4 parts called PITI. P principal, what you owe. I interest, what the bank charges. UT taxes, property taxes. I insurance, homeowner's insurance, so every month, you're not just paying the bank, you're also covering your taxes and insurance through that one big payment. Section 6. What happens if you don't pay? Now, here's the serious part. If you stop paying your mortgage, the bank can start a process called foreclosure. That means they take ownership of your house and sell it to get their money back. It's not something anyone wants to happen, which is why budgeting and having an emergency fund is super important when you buy a house. Section 7. How people pay off mortgages faster. Want to save thousands in interest? Here are a few tricks smart homeowners use. Make extra payments toward the principal whenever you can. Refinance when interest rates drop to get a lower monthly payment. Avoid skipping payments. Every missed month can add huge penalties. Even paying one extra payment a year can help you pay off your mortgage years earlier. Section 8. Why a mortgage isn't always bad debt. A lot of people say, debt is bad. But a mortgage is actually considered good debt because it helps you buy something that can increase in value over time. You're not wasting money. You're building equity, which means the part of the house you actually own. As you pay off the loan, your equity grows, and that becomes your wealth. So, yes, your mortgage is a big responsibility, but it's also one of the most powerful wealth-building tools out there. So now you know a mortgage is just a big loan that helps you buy a house. And it's one of the biggest financial decisions you'll ever make. If this helped you understand mortgages a little better, smash that like button, subscribe, and share this with a friend who's thinking about buying their first home. Because when it comes to money, knowledge is power, and simplicity is everything. Thanks for watching, and I'll see you in the next one.